Here's the part of the interview where you say past results are no guarantee of future performance. But, Katerina, it is kind of interesting.
It's very interesting, Brian. Thank you for having me on the show. And without doubt, this is a challenging investing environment. But it is important to know that we view this correction for exactly what it is, a correction, not as the end of the bull market. Economy is still strong. We're expecting pretty robust fourth quarter earnings, but we have to change our strategy. This is where we go back to asset allocation. This is where the S&P 500 driven passive portfolios might not make as much sense as they did in the previous 2 years. This is where active security selection, attention to valuations, because we know they're going to be under pressure. We know they're going to be earnings revisions. We are expecting, Fed announcement today, even though there might not be surprises today, but they're setting expectations for higher rates, for tapering. We have inflation for the first time to deal with. So we need to change our strategy.
Yeah, inflation's out of control. I mean, are you advising your clients to buy things like TIPS, Treasury inflation protected securities, which are boring, but right now kind of interesting, I guess, or other defensive inflation related type hedges?
Brian, we are advising the clients to build a diversified portfolio of inflation hedges. And there are a number of things that can be used. Real estate, high dividend paying stocks. Real rates right now are more important than ever. We need to look at infrastructure. We need to look at defensive plays. We generally are looking at the stocks that have the staying power and the power to maintain their earnings. Because again, while in the normal environment, we're looking at total return, and that will always be a focus. Right now, real rates, inflation adjusted rates is the focus, and inflation hedges and diversified portfolio of inflation hedges makes more sense than ever before.
I'm sure you're getting a lot of nervous calls from clients, or maybe just curious calls. What the heck is going on? Everybody knows the Federal Reserve is going to raise rates this year. You can dither whether it's 3 times or 4 times or 5 times, but the 25 basis points are kind of irrelevant. You know they're going to raise rates. It's the timing, I think, that's more interesting. Do you think that what we have seen this month and all the volatility in January, Katerina, was just the market doing what it does now? This is kind of a new phenomena where it adjusts faster to anything than anybody can previously estimate. We crashed on the COVID news, and then the market rebounded. Like in April on the COVID news, the market moves faster than ever now.
Market is moving faster than ever, and we have to react to it faster than ever. That's why we have to have a plan before. When we go into this market, the good thing is that we get so much information, there are hardly any surprises. So we can look at our asset allocation, and not just in terms of sectors, but geographically, because let's face it, we haven't seen the recovery on the global level yet. So there are opportunities both here in the US in the defensive sectors like healthcare, like financials, like infrastructure, like consumer discretionary, when we employ this active management approach and are very careful in our security selection. But we can also look for attractive valuations and opportunities overseas, because what we're seeing in Europe with large European companies just beginning, they're just following our lead. We have been so much farther ahead than them in recovery, and they're catching up, and eventually we will start looking at emerging markets too. But global diversification is the key, and a good coherent plan in terms of inflation, in terms of rate hikes, and how all of this translates into the asset allocation and portfolio design is more important than ever. This is going to be the year when we have to pay attention.